Okay, we're going to get started. Um, this is one of the most interesting weeks for interest rates. As you can see from the chart here, this is our first time that we've had this inversion not work. So we've had the US Treasury going down this week. You can see it went down a lot, and the stock market actually went down with it. Until this point, for the past year, we've had, as the interest rates yield goes up, the stock market goes down. But now what we had a report, an unemployment report that basically said that the United States economy is not doing so good. And we might go into a recession. And that caused the stock market to go down. Because whenever there's a recession, the stock market basically goes down around 15%. And we may or may not have a recession, but we are having a slowdown in the economy, which affects the profitability of the companies that we're following. So that's a very interesting turn of events. So now that news, which was bad about the economy, is bad for the stock market for the first time in at least a year. So that was a very interesting turn of events. Let's look at our calendar, what is going on. Okay, so this week we had a set of earnings from companies. Let's look, and this coming week we're going to have some more earnings coming out. A lot of healthcare stocks. We have Amgen on Monday. We have CSX, Berkshire reported before the bell on Monday, and Novo Nordisk, Eli Lilly. So we kind of had a wake-up call last week with some of the tech companies that some of the AI trades aren't going to work out that well. So we're going to go over that a little bit later on. Let's look at some more of our, so what we're doing right now is we're at the end of earnings season. We're going to have a whole month or more of not a whole lot of news coming out. And traditionally, August, September have been some of the worst months. We've been saying that for a year now. So hope you're ready for that. We look at our average monthly stock market returns, August, September, two of the worst months every year. It isn't always like that, but you got to be ready for this. This is like the stock market's ready for everyone on TV kind of talks about this being a bad time of the year. Maybe it feeds on itself. I don't know, but these August, September have traditionally been some of the worst months of the year. A lot of times towards the end of the year, December, in November and December, we usually have better returns. So you got to be ready for this. As a long-term holder, you have to be ready for the ups and downs. And we've been preparing for this for at least a year now. So get ready. Okay, S&P is down 2% since last week. We had earnings that didn't really match expectations, and that caused a lot of selling. We're losing a lot of momentum in the stock market. So now we have only 55% of the S&P above the 50-day moving average. It was 68, and the 68% now are above the 200-day, and that used to be 76. So we are definitely losing momentum, especially with the big 7 tech stocks. Now, let's see what else is happening. Okay, so it seems like the Fed is almost guaranteed to reduce interest rates at the September meeting. So September 17th and 18th, we're going to have an interest rate reduction by the Fed. That may or may not be good, because if they reduce the interest rates, that means the economy might be in bad shape. and there could be a sell-off. That's why we've been having this red in September for a while. So this could be a very volatile time of the year. So you got to be ready for that. Now, okay, so from the beginning of the year, we've been talking about revert to the mean. So the sectors that did bad last year, we expected to do better this year. It took until about this month or last month where these the ones that are unwanted from last year are starting to outperform this year. So healthcare, telecom, financials, and energy are all the ones that are doing good now. And lately, the tech stocks have been not doing so well. So this is actually coming to fruition. So we'll go over that a little bit later. All right, hold on. Okay. All right, so right now the biggest theme of the stock market is interest rates are definitely going to be going down. So because of that, there is a lot of reach for yield. There are a lot of market participants trying to lock in some yield before those rates go down. That's why healthcare, telecom, financials, energy, and utilities are popular now. And you see, because for instance, in a year, you're not going to have very good rates. So your treasuries are going to yield maybe 2% in a year. And people are going to be wanting that 8 or 9% yield that you can still get now. All right, so let's look at the S&P. You can see that the S&P had a perfect uptrend. We had our channels drawn for at least over a year. And right now we're actually breaking out of that long-term trend. We're oversold, but this could be a break of trend, or it could be just an anomaly. So we are going into one of the worst times of the year. So this could be developing a lower high, lower low mint kind of pattern. We don't know that until this coming week, basically. That'll tell us if we start going back into this uptrend or not. But we are definitely oversold where there's fear in the market. And let me see. Let's look at some more ideas. We already talked about this, the inverse correlation for the 2-year and the 10-year, it stopped this week. So if interest rates go down, that's a hint from the bond market, which is smarter than the stock market, that the economy is not doing so good. So that was good while it lasted, I could say. So now we can't get that hint. We can't get a nudge from the US Treasury whether the stock market's going up or down. All right, so let's look at some of the major variables in the stock market. We've been saying for a couple months now, we see weak oil. Right now, oil is down another 4%. And we've been saying that as oil prices go down, that's an indication that there's a lack of demand of oil in the global economy. That means the economies around the world aren't doing that great, and they're slowing. And that slowing could, in the United States, that could hint of a recession. And recession is something doesn't happen very often, but when it does, stocks go down around 15%. You see. All right, gold is starting to go up. It's up 3% this week. So as the stock market is unstable, people gravitate towards instruments that are a little more stable over time. All right, so the US dollar is basically, it was going up in this little uptrend, but now it's kind of settled into a sideways pattern. So it doesn't have a whole lot of effect now on the stock market reports if it's going sideways and not really appreciating. The fear greed index, we are definitely more fearful every week. Investors are more fearful. We're almost to extreme fear. And whenever we have extreme fear, it's time to hold your nose and buy or don't sell. According to Jim Cramer, that's what he says. But right now, we still have fear in the market, and it's primarily because of a fear of a recession or a slowdown in the economy. All right, so this AAII survey, the participants are still bullish. I can't understand that. You'd think they would be bearish whenever people are fearful. Maybe they just don't update this. I don't know, but they're more bullish now than they were last week. So let's see. Okay, the VIX is spiking. You could see that the fear is gripping the market. People are starting to be more fearful. And that's the time when the professionals go out looking for some good deals. We're not at a crash situation yet, but we're very close to, we're at 23 right now on the VIX, which is pretty high. All right, so I would say we're right here in our emotional graph. So we've had this new paradigm all year long for AI. We have delusion, it's on the front page, everything's going up. We had a little pullback last week and the week before. Now we're starting to get some fear. We're getting 30% sell-offs in stocks every day, and we have a possible U.S. economy slowing down as the reason of going into a crash. So, and we have some isolated earnings reports that don't meet expectations. So let's keep a track on this. We are going to a historically bad part of the year, and we have to be ready for any kind of capitulation if it happens. We just had some notes from Warren Buffett today that he sold a portion of half of his Apple stake, and he's developing a large cash position. So Warren Buffett traditionally has waited for the despair in the stock market before he buys. So perhaps he's selling stocks in order to get ready for this capitulation. I don't know. But we have to be wary of any kind of things that other people are doing because they might know more than we do. All right, so okay, so we're still at a PE of 21 in the stock, 24 in the stock market. That's pretty high. The average is 18. So we could go down 15% and still be going back to a mean average. So reversion to the mean says that we either improve the earnings or we make the PE better or we correct 15%. So we have to be ready for a 15% correction in the stock market if we're long-term investors. All right, so let's look at our first to worst. And this is finally starting to turn around. Let's look at these ones that did bad last year. Healthcare, energy, consumer staples, and utilities. These are high-paying dividend stocks, and they were not popular last year because all of the AI stocks, all the technology were doing the best. And who wants the slow-growing, dividend-paying stocks? Now, look at this, 10%, 6%, 12%, and 17% for utilities. These are all outperforming, doing really good. IT and communication services are still the top sectors, but they have gone down a good 5 or 10% recently. So our themes from the beginning of the year, losers of last year will be winners of this year. It's starting to turn around just this week. So right now, the winners of last year aren't losers of this week, this year yet. AI revolution was working up until beginning of this month. Weight loss drugs. We're going to have earnings this week from Novo Nordisk and Eli Lilly. So they're getting competition for weight loss drugs, but they probably are the only two that are actually making a lot of sales. So they're probably going to have good earnings this week. Let's watch them. And all right, so okay, if you could see, this is our updated year-to-date performance. We have the communication sector, IT, and utilities at top 3, and financials at close 5th, and consumer staples. All right, so that is, I'm just looking at this year to date. Consumer discretionary, which was the best, one of the best from last year, is the worst this year. So that is a very good example of worst to first, and how important it is to balance your portfolio so that when one sector is out of favor, the other sectors could be in favor. Let's look at that chart we've looked at for a long time. This is worth it, right? This one right here. This gives every sector and what their returns are every year going back to 2009. You can see that, let's look at the, let me see, utilities down 7% 2023. Telecoms down 40% in 2022. So you have, like this year, we have telecoms doing better. We have utilities doing better. So you have to make sure that when you're investing that you have a diverse portfolio so that whenever one sector is doing good, maybe another sector that's doing that makes up for another sector doing bad. All right, all right. So now this is basically a turning point in the stock market where it's going to get important to have diversity in your portfolio. All right, so now let's look at the sector ETFs. Okay. Okay, let's look at the market movers, up and down. Okay, for the up stocks, we saw a lot of dividend paying stocks. A lot of these stocks yield around 2% or more. We have a REITs, PSA, public storage. We have extra space storage. These are paying dividends, and REITs have been out of favor until this year. So this is the example of worst to first, where the REITs are starting to outperform. They pay high dividend. There's a lot of people in the market that are reaching for yield. They know in a year they're not going to be able to get a 5 or 10% yield, so they're gravitating towards stocks, REITs, and entities that are paying higher dividends. McDonald's pays a big dividend. All right, so that's the theme for the ones going up. The ones going down the most, look at this. Intel, they had a earnings report where they basically threw the kitchen sink, well, it's called a kitchen sink quarter. They basically said they weren't going to meet estimates. They're not going to have good earnings going forward, and they took a lot of losses. So it was just an amazing thing. We've been talking about Intel for a couple years now as a stock, basically to avoid, because they're losing market share to AMD for the data center, and now they're not keeping up with AI. So they're, even though they got $8 billion from the government, from the CHIPS Act, they still are laying off 15% of their people. So whenever you see big layoffs, like 15% of their people, that company is not growing. They're not expanding. They're contracting, and they're trying to survive, and they stop paying a dividend. So you're going to lose this 26% that was lost today. Any company or any any mutual fund that invests in Intel for the dividend has to sell. And they have to get rid of it because they're not paying a dividend anymore. A lot of people just buy a stock for the dividend. And what happened is you see all these chip companies um, that are going down with it. So you have Micron. Whenever one stock goes down 26%, a lot of times other stocks that are chips go down in sympathy, whether they're related or not. That's what happened here. A lot of these stocks are going down that are microchip, they're chip related companies. All right. So let's look at some of the NASDAQ stocks going up and down. We have the eBay of South America, Mercado Libre. We have a lot of dividend paying stocks. The Pepsi, they are example of a dividend paying stock that are consistent growers over time, maybe 2% growing, 2% dividend. We have Coca-Cola. Almost all these are dividend paying. And the ones doing the worst in the NASDAQ, almost all of them are chip related. And we have Amazon. They had a disappointing earnings report. All right, so that was a good little excursion. Let's look at some of the, hold on. Okay, let's look at the ETFs for this week that are going up and down. So we had a huge drop in interest rates. That should help the homeowners, the home builders, the, let's see, the one's doing the worst and one's doing the best. Okay, we have consumer staples doing the best, utilities. Okay, so these are stocks that are going to pay a dividend. Real estate. Okay, so when we have a drop in interest rate, that's going to help the real estate because more people can afford to buy houses and for mortgage rates. Now we have utilities. When interest rates go down, people are reaching for yield. So any kind of sector that pays a high dividend is going to be high in a high demand because it's consistent growing and they pay a dividend. And whenever the stock market's crashing, people want some kind of return. Real estate, we have healthcare. These are all high dividend paying stocks that are going up the most. We have home construction, benefits from lower interest rates. Materials, biotech. Okay. Okay, as interest rates go down, you have a benefit from small caps and biotech because it costs less to borrow money. And a lot of those companies don't have a lot of cash. They have to borrow money to exist. All right, that was a good example. And of course, the sector going down the most is semiconductor because one of the biggest stocks in that ETF, Intel, went down 26%. So, oil, why would oil and gas exploration and oil services go down? Well, the price of oil is going down. And if there's a recession and slowing of the economy, oil prices will go down because of a lack of demand. That will cause these oil companies to have less profit because they won't be pumping as much oil. And okay, and the banks are down probably because of the interest rates. And that was a good little exercise. Glad we did that. Let's look at our talking points again. Dan Niles picks from the beginning of the year. You can see that Amazon is still up 16% even after this down week. We have Meta up 38%, and they're probably benefiting from the political spending. They had earnings, they were pretty good. Texas Instruments up 12%. XBI, the ETF for biotech, is up 8%. KWEB is up 5%. This is the Chinese ETF for the tech stocks. All right, so far Dan has been pretty good with his returns so far in his picks. I found this big picture on Twitter. This is pretty interesting. It gives you a big view of $1,000 invested since 1925. And it gives you the returns over a period until last year. You can see that U.S. stocks are probably the best return over since 1925. You would have returned 10% if you had your money in stocks. And the growth portfolio is up 9% since 1925. Balanced portfolio is only up 6%. International stocks up 7%. And income portfolio is up 5%. So you can see the different returns for the different sectors. Some say that you have to have a well balanced because over time you're going to have good returns from each one of these different types of investing. Another good little chart here is the bull and bear markets in U.S. stocks. You can see that beginning in the 1920s, we had a huge downtrend in the for the Great Depression, and you could see the bear markets are very, very small compared to the bull markets. So you can see that we've had this bull market since 2008, which is pretty amazing. And then we had a little crash for the pandemic. That's an example of 90% of this time the stock market is in a bull market. 10% you have these mini corrections, but you have to make sure that you're ready for these, and because you don't want to sell and then never get back in. That's very tricky. So this also is a chart that basically says that if you invest, your chances of success go up the longer you hold a stock or your investment, regardless of what type of investment is. All right, that was a nice little excursion. Okay, so the earnings reports from this week that came out, we had on Monday, McDonald's, they had disappointing earnings. McDonald's basically said that the lower end consumer is having trouble. So there's like these little canaries in the coal mine that we have to listen to. We had problems with Starbucks where they were saying people aren't buying as many cups of coffee. So we have some stress on the lower end consumer, and that's could hint at a slowing economy. We had reports from, I highlighted in red the most important ones and the ones that we're following. We had Procter & Gamble came out with earnings on Tuesday, Microsoft and Altria on Wednesday. We had MasterCard and Meta. Meta came out with really good earnings, I thought. Amazon disappointed with their earnings report. Apple did better than expected. And Intel is totally cratered on Friday when down 28%. They basically said they're not going to be as profitable. They're laying off people. They're basically not in growth mode anymore. And that kind of freaked out the whole semiconductor sector. And we had ExxonMobil come out with earnings Friday also. For next week, we're going to have earnings coming out for Berkshire Hathaway before Monday open. They actually, I think they came out with earnings on Saturday. And CSX, the train company, they're coming out with earnings on Monday. Amgen, a lot of drug companies coming out with earnings this week. A lot of times whenever there's earnings, the sectors report together. Like the first week of earnings usually have a lot of the banks. Last week we had a lot of the big tech stocks. This week we're having a lot of drug companies. We have Novo Nordisk and Eli Lilly coming out Wednesday and Thursday. That's going to tell us a lot about the weight loss drugs and drugs for diabetes. And they're supposed to be coming out with very good earnings. That could help or hurt the stocks when that comes around. So after this week, that's a lot of the earnings that are coming out. And I'd say after this week, it'll be 75% of earnings already reported. So there's nothing really exciting after this until for 3 more months. All right, I pulled out some charts of interest. These are stocks that are that used to have these wonderful patterns, and now they're basically breaking out of those into simpler patterns. We had Google that was in this uptrend for quite a while. They basically broke out of that uptrend. What I'm keeping track of on a lot of these charts for the indexes and for stocks is the moving average. You can see this purple line right here. It kind of matches this key. It's a 200-day moving average. And that is key for a lot of these stocks that have been in uptrends. And that's like a floor of support for the stock. If it breaks through the 200-day moving average, then none of these stochastics work. The stochastics only work whenever stocks are going up. In this defined uptrend, we have, a channel, and you have high, when it's going up. Whenever it breaks out of the channel and out of the moving averages, then you can't use stochastics for timing your purchases anymore. All right, so let's look at Amazon. Amazon had their stock go down exactly to the 200-day moving average, and that is and something we have to watch. If it goes below the 200-day moving average, there's a very good indication it's losing momentum, and it could start a downtrend. So as a follower of this stock, you have to watch that. If you're thinking about buying some, you have to make sure that there is some kind of support here. Right now, we have a lot of support. We have a channel that's been going up for a while, and it's oversold. There's a couple good indications, but we are going to 2 worst months of the year. So a lot of these stocks we're following very well could go down from here if they start losing the faith of the investing public. You can see that Microsoft also is at its 200-day moving average, almost exactly, this purple line right here. So we got to follow that, and it's broken through a little bit of its trading range. This was like a perfect setup where every time it hit its low end of its uptrend, it bounced off of that. So let's see if this bounces. If it goes through the 200-day moving average, it lost its momentum, and it's a very good chance that it will trade down for a couple months. Okay, let's look at Walmart. Walmart is one of the most powerful stocks in the stock market. It's going to be doing good when the consumer is stretched. Right now, they're basically benefiting from a consumer that they're not buying their Starbucks, they're not buying their McDonald's, but they're trading down and buying at Walmart the essentials. So that's why this is such a great stock. It pays a dividend. It's in high demand because of a dividend right now, and it'll still grow in a weak economic environment. Let's look at T-Mobile. We mentioned the stocks that did bad last year where telecom was one of the sectors. Now the telecom stocks are on fire because they pay a dividend, and they're also steady growth. And we've been following this for a while. You can see it's at the top of the channel. It's not the time to buy that right now. It's overbought. But you can see how almost at the flip of the switch at the beginning of this year, stocks, like the telecom stocks are a trade that's in vogue. Let's look at this new story on Intel. It says Intel stock plummets most in 40 years amid massive restructuring. So the guy that's in charge of this, the CEO of the company, he basically took over a company that was in a decline. They were losing market share to AMD, and now they can't find a way to get into the AI world either. So they recently got $8 billion from the government to build a foundry chips factory in America. Even with that $8 billion benefit, they're still doing bad, and they missed on their earnings. So what I did was I put up a oh well, this isn't very good chart. I'm going to try to get a better chart than this. Okay, so Intel has been one of the worst semiconductor stocks that you could have bought in the last 20 years, because basically it's where it was 20 years ago. Let's look at the chart for this stock. I suppose you've gotten a dividend if you've held the stock this long, but you can see it went down to $21 a share. Look at that. It's totally oversold. But 1 year ago, it was at 24. But let's zoom out. Okay, so we have in 2017, it was $36 a share. So now it's trading for, if you bought this, if you bought this in 2017, you would have lost money. And their earnings projections aren't that great for the future. So not only have you've gotten a dividend, that's about it. So if we look at their earnings projections, this reminds me a lot of Boeing. Look at these negative earnings reports. I mean, they lost money in this quarter. They're not meeting estimates, again, not meeting estimates this quarter. That's pretty inconsistent. And you can see that between last year and this year, they made $1.05 last year. This year, they only made 47 cents. So that is a company that's not growing. I'm not sure how reliable this growth is here, but I suppose maybe a company like NVIDIA could buy this company for making their chips. That could make sense. But this company is in decline. They used to be, that's why it's important to realize chips, this company, Intel was on top of the semiconductor world in the 1980s, maybe 1990s. It's really hard to stay on top in the semiconductor world. There's always competition. And that's the same thing with NVIDIA. Right now, NVIDIA is on top of the semiconductor world. But as soon as they have something that's proven to be profitable, there are companies like AMD and Amazon that are building chips that compete against it. So it's not a guaranteed. Once you have a good product, it's not guaranteed that you're going to stay on top and continue to have sales over the long term. That's why this sector is pretty dangerous. All right. All right, that was a good little exercise. Okay, here's a little story that just came out. Buffett stock sales in Q2, the most ever. So we have one of the most, well, arguably the best investor of all time, generating a lot of cash. Um, his net purchases versus net sales of equity securities is the highest of all time. So there's some people saying that Buffett calls the top. Berkshire quietly dumps half of its Apple shares amid unprecedented selling spree. So basically we have a very smart investor selling, getting ready, getting a lot of cash available. Why would he be selling a lot of his holdings for cash? There are some saying that um, Buffett knows we're going into a recession. Things are overvalued now, and maybe the stock market will drop, allowing him to buy things less expensive later on. I don't know. So let's see. There's a CFRA research analyst said their Apple stock sale looks more like a good portfolio management, given the iPhone maker had grown to half of their portfolio. So that makes sense. You know, um, if they sell their stake for so that right now Apple only makes up 30% of their portfolio. So okay, so I looked at their fundamentals. Berkshire Hathaway just came out with their earnings. They're um they're growing around they're growing their earnings around 10% per year. So from last year to this year is 10%. The interesting thing about this company is not a whole lot of companies are following and making estimates for the company because it's so hard to analyze. They have so many different stocks that they hold. On top of that, they have individual holdings like Geico, which they own 100%. Now, there's no analyst that can truly understand. Well, it's very hard to analyze that kind of stock. Because of that, we don't have earnings estimates that go out that far. But Berkshire Hathaway has returned on average around 18% a year, compounded since the 1960s. So when you own Berkshire Hathaway, you have to realize you're not going to be able to understand all this. You know you have the best investor of all time making decisions on behalf of the company. Um, and he's been successful in the past. And you have to just realize that this guy, Warren Buffett, knows what he's doing, and you have to have trust in his methods for buying companies and managing all of the companies that he has. So, um, that was a good little exercise. But this is the biggest news article that I'm going to go over today. Um, hold on. Okay, this is a article from the Wall Street Journal. We were talking about how the 10-year was going down in a major way. You can see that this chart right here shows the Treasury yields in a huge correction. And you can see that the Magnificent Seven are also going down in the past couple of weeks. So the summary of what's going on in the past 2 weeks of earnings, there's a drumbeat of skepticism about the benefits of AI and whether it will actually deliver profits and profitability and productivity at the level that's being promoted. So that's why Amazon's down. That's why Nvidia's down. Um, so there's a fear of growth and slowing growth, and rattles the financial markets around the world. So whenever we had these earnings reports happen this week, we had a payroll report that showed job growth is slowing. So there's a scare on Wall Street that the stock market and the global economy is slowing. That means people are going to pay less for stocks because there's less growth if the economy is slowing. So this will all have a lot, well, whether the stock market goes up or down, and we're going to be watching these government reports to see how well the stock market, how well the economy is doing, how well unemployment is. So as a long-term investor, you just have to realize the economy is going to go through a growth phase, and then whenever the interest rates go up, it'll decline into a slower growth. And like this chart that we had when we started, you have to, where is that chart? Right here. You have to be willing to go through a little bit of contraction, bear markets, in order to enjoy the bull market times. And that is my talk for today. If you have any questions, send them my way and I'll try to answer them for you for next time. And I hope you have a good investing week. I'll see you all next time.